In today's episode, we're going to go over some listener questions that we received that I think can help everybody out. We're going to talk about when you have life changes, whether or not you should move your investments to cash. Questions that came in regards to retirement travel spending. How much can you spend in retirement? Is it okay to spend more than when you were working? Real estate and taxes. People that inherited property, they have a question about whether or not they're going to pay taxes after they held that piece of property they inherited for 2 years. And then last, questions in regards to mortgages, paying off your mortgage early, and should you keep your mortgage around for the tax deduction? Stick around. Lots of great questions, strategies, points, and tips to be able to learn from in today's episode.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome into the Retirement Show, all about your life, your money, and today, we're going to talk about your financial questions. That's right, we're going to have a mailbag episode. I love the mailbag questions. You see a lot. We sit and talk about specific steps in the retirement planning process, strategies, tactics, things to do without putting it to potential real life scenarios. And so that's why I love the mailbag questions because, really everything that we do comes down to the individual or to the couple and to their specific situation. And we're all unique in this world. I mean, it's really fun for me to see as people come into our doors and sit down and talk about their personal situation, their retirement situation, what they want to their retirement story to look like. They're all unique. They're all different. And so what does that tell me? That all of these planning steps that we talk about, they can apply to everybody in such different and unique ways. And so today's a mailbag episode. We've got a lot of great questions that have come in. And as you listen to these questions, even though I just said everybody's unique and different and has their own personality and their own retirement story that they want, we can always learn from others' questions. We can always learn from somebody else's scenario. We can take some of those strategies and apply it to what we want to do or what we may need to do in our lives. And so hopefully you'll find that in today's episode. We're going to talk about a person who has some life changes and then they're wondering, hey, should we shift all of our investments to cash because of these life changes? What is acceptable from a retirement travel spending amount? So we'll talk about that. Is it okay to spend more in retirement than in your working days? What does that look like? Is that heading in the wrong direction? Is that the right direction? We've got questions in regards to real estate and taxes. So if you have inherited a property, but then they held it for a couple years before deciding to sell it, what does that mean from a tax standpoint? And then this age-old question of should I pay my mortgage off or not before I get into retirement? But this one specifically because this listener heard some things in regards to mortgage tax deductions. So that's what we're going to talk about today. We've got 4 questions to go through. If you have not joined our show yet, my name's Scott Searins, and my goal is to help you thrive in life, wealth, and retirement. And hopefully today's show helps you do just that. If you've been listening to our content, or if this is your first time and you like our content, you like our podcast, you enjoy the YouTube channel, well, subscribe to our Insiders List. If you're not yet subscribed, you might find this really helpful. What it is our weekly email where we give tips in regards to helping you maximize Social Security, ways to help reduce your retirement taxes, and plenty of other retirement topics. Some of our latest examples were rebalancing accounts, how to get more tax-free money for your retirement, and tips to help maximize your 401k. So if you'd like to subscribe to our Insiders List, you can do so at lifemoneyshow.com. Again, that's lifemoneyshow.com. Right on the homepage there, you scroll down, and you'll see an area where you can sign up to be part of our Insiders List as well. Again, you'll get those weekly emails that'll come out with content to help you, to help your retirement, to help you build wealth, and help you reduce your taxes. That's our goal here, and that's what I enjoy when it comes to providing and making all this content, and I hope that you find it enjoyable as well. Okay, so with that, the listener questions that we have today, as I had kind of previewed them, let's start with number 1 from Carol. Carol says, I have a lot of major life changes occurring in the next 6 months that I think will affect how I should be invested. Should I just park my money in cash until life settles down and I know what my future will look like? So just to recap Carol's question, we've got major life changes coming in the next 6 months, wondering if that impacts how she should be invested. And then Carol takes it one step further and says, should I just be moving all of my money to cash until she gets through these life changes and knows specifically what her life will look like in the future? This just shows why they call it personal finance, because part is personal, part is emotional. And those emotions can sometimes make us do things with our finances that wouldn't necessarily be logical. So I really respect Carol here, and I appreciate that she's recognizing that she's trying to tie the emotional with the financial, right? The personal with the financial. She's recognizing that instead of just making a major change, she's hitting pause, and she's going to ask the question, and she's going to get help. And she's going to just take a second, and she's going to think about it. So if you're ever going through any big changes, remember, sometimes those big changes can really bring our emotions up and make us make decisions that sometimes if we would have thought about it or we look back, right, hindsight's always 20/20, we realized, oh man, we made an emotional decision, but it wasn't the best logical decision. So sometimes it's those emotional decisions are not always the ones that we necessarily regret, but sometimes that we wish that we could take back or we wish we could have done differently, because once we got through it and we thought through the logical part of it, then we're like, oh, wait a second, maybe that wasn't the best thing to do, but our emotions were high, right? It drove us to that. So think about this. Think about this. I talk about it in our workshops or retirement workshops all the time. Logic versus emotion. Logic versus emotion. Do what's logically right for you and learn and help separate those emotions. Okay, so let's then get back here to Carol's question. Again, great job on hitting pause and sending in the question. So, Carol, what type of life changes are you going through? Now, since we don't know necessarily for the podcast today, we're just going to give you some general advice to use, some different paths to go down. One of the questions that's on my mind is, why would the life changes change your investment? So let's just kind of walk through some different thoughts here, scenarios that other people, I'm sure, are going through life changes too, and they can put themselves into this pattern, into these kind of thoughts and patterns here to see what maybe they need to do for their lives as well, Carol. So thanks for sending the question in. Okay, so here's my thoughts. Will the life changes require income? Are they going to require you to withdraw money? Now, if the answer to those are no, so these life changes, they're not requiring any more money today or any more income today or for you to take money out of your accounts. If the answer to those is no, then I'm going to stick to the general rule that you've probably heard throughout our podcast, is that you're going to want to have the next 3 to 5 years of income needs, withdrawal needs, over in your war chest, that pool of funds that's subject to less volatility than the market. Now, that could be bank account money, that could be bonds, that could be high-yield savings account. Again, pool of funds that's not subject to the same volatility, those same ups and downs, right? We saw those downs last year in the market. So far this year, we're seeing the ups, but it can go both ways. And so the pool of funds, it's not subject to the same volatility. Why do I say 3 to 5 years? Well, the reason for that is because, if you kind of look at history when it comes to the market, if it does correct or if it does crash, it has taken 3 to 5 years to bounce back up. You look at 2008, it took 5 years to get back up to where it was prior to its crash. So that's why I say, okay, we want to carve those next 3 to 5 years of funds that we actually need over into that war chest. But we need balance in our lives because Here's the thing, Carol, you move to cash. You keep that cash too long, then you get scared, again, back to those emotions. You get scared about, well, when should you put it back into the market? Because the market's going up, the market's going down, and there's always this excuse of why we shouldn't put it back in the market. So you take it out, then it's tougher to put back in. And when it's sitting in cash, I realize interest rates are great right now, but they're not always going to be that way. History has shown us that as well. When then, or how I should say, do you have money growing for your future? How do you have money keeping up with inflation for your future? Now, everybody's war chest can be different. This is where I always say balance in your life. So if you feel like, for instance, you're more, I'll say, aggressive, maybe you have a 3-year war chest. If you're more conservative, maybe you have a 7-year war chest. But you need that money for growth, because growth helps us outpace inflation. The reason interest rates are up is because inflation is up. Interest rates are still lower than what inflation currently is, and that's kind of how it's always fallen. And so just having your money in a high-yield savings account, it's not going to help you keep up with inflation. That's why we need money on the growth side, equity is growing, etc. So that's my first, again, do you need income now? Do you need money now? If the answer is no, making sure that you got your 3 to 5 year war chest. And then after that, we still need to have money in equities growing for your future, outpacing inflation, making sure that it's there for your future. Okay, now, let's just say the answer to the question was yes. Will the life changes require income right now? Will it require you to withdraw money right now in that next 6 months? If the answer is yes, then I would shift that specific amount to cash. I hope you heard me there. I didn't say shift everything to cash. Even when the answer was no, I hope you heard me there too, right? 3 to 5 years in your war chest, but everything else still growing. Same thing, if the answer is yes, we want to keep 3 to 5 years in your war chest, but one thing you would want to do is that money that you're going to need in the next 6 months, shift that over to cash, because you don't want that money at risk. You're going to need it in the next 6 months. And so why not have that particular funds that you need in cash ready to go for what you need? So again, I don't know what your life changes are, but I hope walking you down these 2 different paths helped you separate emotions from logic, and how much money you should have at cash, but also how much you should still have growing for you and your future. Carol, thanks for sending in that question. So moving on to our second question of the mailbag episode. Here we go, from Charlie. How much is a reasonable amount to spend on travel in retirement? Interesting question there, Charlie. My wife wants to do a couple of big trips every year, but if we do that, we'd end up spending even more money in retirement than we do now while we're still working and have paychecks coming in. That can't really work, can it? Well, Charlie, actually, it could work. It might work. It might not work. It all depends on what you have saved. I know you're like, of course he's going to say that, right? It depends. It's like that general answer, general response. But I'm going to walk you through everything here. Just give me a second. But it all depends. It depends on what you have saved, and it depends on what those lifestyle expenses and needs are. So one of the things I'd really recommend here for you, Charlie, is have you ever taken and broken down? It sounds like you have here because you know specifically what's going to go into travel. But just for others that are listening as well, just making sure that we break down. This is a huge, huge help for retirement in helping people understand what they can spend in retirement and how much they can spend on travel. Or maybe if you're listening to this, travel's not your thing, but something else is. But talking specifically to Charlie's question here, do you have broken down what I'll call are your needs and your wants? Needs and wants. What are your needs? Those are the necessary expenses. House, groceries, transportation, utilities, the things that you need to live and survive each and every day. First off, fully understand, everybody out there, what are your needs, meaning your lifestyle expenses that are needed. Then after that, what are your wants? Now, Charlie's example here, or question, sounds like his wife has a couple wants, and those couple wants are due to a couple big trips every year. The next thing that I'll ask you to add to those wants is every year, I get that, but for how long? Till you're in your 80s, 85, 90, until you pass away. What are those wants, but also how long? Get to that in a little bit. Okay, so we've got our needs, we've got our wants. Then we can start putting that into your plan. Maybe you want $5,000 a year for travel. Maybe it's $15,000 a year for travel. Maybe it's $10,000 a year for snowbird, to be a snowbird each and every year. We live in Illinois here. You know what? The winters can get pretty brutal, and I don't blame people for saying, hey, I'm going to go find a nice warm place to stay during those cold months. So after we have all of that, then what I'd recommend, Charlie, is putting together an income plan and an investment plan. And when you put that income plan together, tie it to the investment plan. Kind of just talked about that in question 1, right? Money we've got growing for our future, 3 to 5 years in our war chest based on the income needs that you have over these next 5 years. You can use that income investment plan to say, okay, does it support this? Does it support the travel? Does it support the other activities that you want to do? Does it support it from now until age 80 or 85 or 90 or whatever that is that you want to do? So that's how we go about finding out if that will work for our clients. Now, just a very high level general response. Does it make sense that your expenses could be more in retirement than in your pre-retirement years, than in your working years? Yeah, absolutely. You know, I find that there's kind of like 3 phases that people go through. That first phase, I'll call it the go-go years. You retire, you're young, you're healthy, and you want to go and do all the things that you've been saving all that money up to do. After that, you kind of go into the slow go years. Even though our minds are telling us, yes, we're going to do all these things forever, the body sometimes slows down. And then you hit the slow go years. You're doing things, you're just not doing as many things as you might have done in the go-go years. And then you kind of hit those years of the not so much going out anymore. And so, Charlie, you might feel really stressed or tense or questioning things right now because it's like, wow, we're spending all this money up front. But just know those expenses could potentially go down. So as you go from those go-go years to the slow-go years. But then remember, in those not going out so much years, that's kind of sometimes when the health thing starts to come in. So those expenses could tailor back up, towards the end of the retirement. So is it possible that your expenses in retirement could be more than your working years? As I mentioned before, yes. But one of the things that you really want to do, Charlie, is you want to put together that income plan and your investment strategy to match your income plan, and then test that out just to make sure that it supports not only your needs, those lifestyle needs that you have, but those wants, those extra travel goals that you're adding into it as well. So an income plan, what that is it's all your sources of income that are coming in each and every year, what's going out. Don't forget taxes, don't forget health, don't forget Medicare. So in, out, and inflation. And then what is that deficit? Will your investments support that deficit throughout your lifetime? Charlie, I hope this helps you in your question. I know it doesn't give you the specific answer to tell you, yes, go on those vacations, because you need to test it out. Now, maybe you can do that on your own. If you're not somebody that can do that on your own, then I would recommend getting help. You can talk to a financial professional, somebody like us. People talk to us about those questions each and every day. We're helping them put together those income plans and those investment strategies. If we can be of help to you, Charlie, go to lifemoneyshow.com, click on the Work With Us tab. All right, our third question here from Joseph. Joseph said, my mom died 2 years ago, and my 3 sisters and I inherited her house. I've always wanted to sell it. They're just now coming around to the idea, but now they're worried about the tax implications of selling the house. I keep telling them that I don't think it will really hurt us from a tax perspective, but I can't really explain why. Can you help me? Well, Joseph, just like I told Charlie, it depends. You knew that was coming, right? Well, it may or it may not hurt you from a tax perspective. And let me just kind of walk you through why I say that. Because there's this nice little IRS rule called the step-up in basis that took place when your mother died. But here's the thing. It took place when your mother died, which was 2 years ago. And so it could create some taxes for you and your siblings, or it may not. And here, I just want to walk you through. You can plug your numbers into the scenario, and hopefully it helps a lot of people when they think about real estate and they think about taxes, whether you're passing real estate on to your children or whether you're inheriting real estate. Hopefully this example and scenario helps you out. So let's just say here, your mother, I'm just going to say, hey, that she was single. It sounds like, or a widow, but let's just say she had been single for a while here. And so let's say your mother had purchased the home for $500,000. Okay. And then when she passed away, let's say the value of the home was $800,000. Again, here, plug your own numbers in, but hopefully the scenarios will help you out. Now, let's just say your mother would have actually sold the home before she passed away. I want to help everybody here. So $500,000. Let's say she sold it before she passed away for the $800,000. That's $300,000 in gains. Now, there's an IRS code, right, that you're able as a single to exclude up to $250,000 of gains from your primary home. Specific rules that you got to meet. Go to IRS code or Google it. You'll find that. We've talked about it on previous episodes. So $300,000 of gains, $250,000 of exclusions. Your mother would have paid tax on the $50,000 of gains. She had $50,000 in capital gains. Okay. That's not what happened, but I'm giving that. So when people are thinking, oh my gosh, should I sell my home and give it to my children, or should I just let them have it once I pass away? I want you to understand all of the scenarios. So if she would have sold it before she died, $300,000 of gains, she has a $250,000 exclusion. Again, if it was married filing jointly, that's a $500,000 exclusion. In this case, would have had $50,000 in gains here. That's not what took place. So your mother purchased for $500,000. When she died, it was worth $800,000. That's a point in time where you as the children get what they call as a step up in cost basis. Remember in my previous example, there was $300,000 of gains because they take the $800,000 minus the $500,000 that she purchased for. Well, that $500,000 was considered the cost basis. When your mother passed away, you and your siblings, you get what's called a step up in cost basis. Your mother's cost basis, $500,000. She passed away. If the value of the home when she passed away was $800,000, your cost basis, now what everything is based off of, is the $800,000. That's the step up in cost basis. Okay, so if you would have sold right when she passed away, it was worth $800,000. You inherited it when it was valued at $800,000. You sold it for $800,000. Guess what? No taxes, because that was your new cost basis. Now, let's say what's happened is, and in your case here, Joseph, you didn't sell it. You held on to it for a couple years. And let's say the value went up over those couple years. It went up to $900,000. Now, the three of you decide to sell it. Well, $900,000 minus that cost basis, but that step up in cost basis that you got when your mother passed away of $800,000. So $900,000 current value 2 years after your mother passed away, minus the $800,000 step up in cost basis that you received when she passed away. Guess what? That means that you have $100,000 of capital gains, which would be taxable to the three of you. So yes, there could be taxes when you sell. Now, real estate's been doing good, so I'm gonna guess that the price of this home is up, but let's just say for some reason you live in an area where the price of the home went down. So let's say instead of being worth $900,000, it's worth $750,000. Well, when you inherited it, that step up in cost basis was $800,000. $750,000, guess what? That's a $50,000 loss. Now you actually have losses to write off on your taxes. So I think the key numbers, just to summarize all of this here, Joseph, that you want to understand is what was the value of the home when your mother passed away? Meaning, what was the cost basis that you and your siblings got when she passed away? What's the value now? If that's more, you're going to be looking at taxable gains. If that's less, then you could be looking at losses. If it's the same, guess what? You might not be looking at any taxes at all. So the other thing I just want to say is people are listening to this. I get a lot of questions about real estate and finances and selling and taxes, is that if you're inheriting a house and you have no plans to hold on to it, it might be in your best interest to just go ahead, sell it right away. So that way you're not dealing with any sort of taxes. You invest the money how you want for your future. And that might help in regards to this. But that's not what they did. And that's okay because, hey, if it did go up, you've got gains. You just got to pay tax on them. And since your past 2 years, most likely you're looking at long-term capital gains, which are taxed at a more favorable rate. So making money is not that bad of a thing. Even if after the taxes you're putting money in your pocket, I'd say it's still working out in your favor here. Okay. Our last question of the day comes from Andy. Here we go. Andy says, I've been told that I need to make sure I have a mortgage when I retire because that will be the only tax deduction I'll have at that point. I've been paying extra on my house to have it paid off by the time I retire, but maybe I should slow down on that plan. What's my thoughts here? Okay. Andy, thanks for sending this in. I will tell you, you are not alone. We've got a lot of questions as well about making extra payments towards a mortgage. Should I pay my house off early? What makes more sense? And this kind of goes back to our first question here of personal finance. There is such an emotional part to this, and then there's the financial part to this. And I'm going to break this down into two parts actually as well, not just emotional and financial, but your question into two parts. One, the tax deduction part, and then two, whether or not making extra payments to pay it off early makes sense. Okay, let's start with the tax deduction part. Andy, my question to you, and then you can ask this question to your tax preparer, is are you actually getting a tax deduction from the mortgage interest? Andy, the reason I ask this is because right now, the standard deduction that people get on their taxes, those standard deductions are pretty high. And a lot of times where in the past you were getting that deduction for the mortgage interest, well, now the standard deduction is typically higher than those itemized deductions. And if it is, you're probably not getting any benefit from having that mortgage interest at all. Here's what I mean. The standard deduction right now, if you are single, is $13,850. The married filing jointly standard deduction is $27,700. So let's say you're married filing jointly. Well, all your itemized deductions, meaning your mortgage interest, property taxes, charitable contributions, you name it, all of those itemized deductions must be over $27,700 for you to actually be deducting those. And if it's not, well, then you're just taking the standard deduction, which then leads me back to that first point, is that if you're just getting that standard deduction, having that mortgage interest isn't really helping you at all. So be careful listening to friends and other people that say they're getting a deduction. You don't know what's necessarily going on in their lives, what they have from an itemized deduction standpoint. And heck, they might not even know themselves that they're not even deducting their mortgage interest because the standard deduction is so high. So what I would say, go to your tax preparer and ask, are you itemizing your deductions or are you taking the standard deduction? If you're itemizing, well, then you know what? The mortgage interest may be helping you, but I got to tell you, it's not like reducing your taxes a ton. So that's part one. Are you actually getting the deduction? Part two, paying it off early. Well, okay, here's some things to think about. Does it make sense to pay it off early? First off, if you're in like the last 5 years of your mortgage here, most likely all you're paying at this point is just principal, meaning you're just paying towards the equity of your home. You're probably not paying very much interest anymore. So in that scenario, if you're just paying principal primarily, I don't know if it makes sense to go ahead and, pay more towards it to pay it off. The other thing to look at is your interest rate. So, for instance, when I refinanced my home for a lower term and a lower rate, I was able to get 2.5% for my mortgage. Now, my belief at this point, because if you'd listen to the show, you know I'm a big believer in having no debt, getting everything paid off. But the low interest rate of 2.5% kind of changed my mindset a little bit, because I believe that our money can be growing for us more in other accounts. For instance, we have a high yield savings account making over 4% right now. We have money in the market. I believe the long-term returns of my money in the market will make more than that 2.5% as well. So my beliefs changed a little bit on that, because mortgage rates went so low that I've got other money that's outpacing the interest rate on my mortgage. So that's a financial look at it, right? That's just a numbers focus on it. But then there's the emotional thing. And I tell you what, working with lots of retirees, as that's where we focus in our business here, is helping people maximize their retirement story. I just know there's an emotional part of it too. There's this emotional feeling of confidence that when you go into retirement and you don't have any major bills like a mortgage to pay, it just helps you go into retirement with confidence. It helps you understand that bill's done, I don't have to worry about it, and having it paid off just makes some people just feel good about their retirement story. So if that's you, well then go ahead and pay it off. I'm not telling you not to. I think it's fine, because you know what? Again, you're paying somebody interest when you're paying a mortgage. And so hopefully, Andy, this has shown you, first off, keeping it around from a tax standpoint, there's some benefit only if you are actually itemizing your deductions. And, I can't tell you, you'd actually have to ask your tax preparer, hey, my mortgage interest, first off, are you deducting it? Second, if you are, have them tell you how much it's actually saving you in taxes. Because my question would be, are you paying more in interest than what it's saving you in taxes? So those are a few questions to ask your tax preparer. After that, or let's just say you're getting the standard deduction. Now to the other part of paying it off early. Hopefully I've walked you through, there's a numbers standpoint of it, there's an emotional standpoint of it, and you just have to kind of put your chart together to say, what do you specifically want to do? Paying it off early, nothing wrong with that. You don't have any debt, you won't have any bills for retirement, and you can go into retirement with confidence. Not paying it off early, I've got plenty of clients that have a mortgage as well with lower interest rates, same thing. Their goal is that their returns on different investments outpace their mortgage rate. So lots of proper ways to think about it. Now, if you have a very high rate, then yes, if you're in the 6s and the 7s, maybe even the 5s, right? 5, 6, 7s, that's when I'd say, okay, hey, I really agree with you. You're putting extra money towards it, because that's a pretty high rate and you're not guaranteed necessarily to ever get that type of return in your investments. We hope so, but nothing's guaranteed. So Andy, thanks for sending in your question. I know other people out there have a similar question to you when it came to deducting it from their taxes and paying it off early, and I hope that they found my response to be of help to them, just as it was hopefully of help to you. Hey, thank you all for sending in your questions. If you have questions, you can go to lifemoneyshow.com, click on this specific episode, and on the right-hand side, there will be a box to be able to submit your questions. So if you have questions, feel free, submit them in. We really appreciate everything that you send in, because I know it's probably helping you and helping others. And last, as I mentioned at the beginning of the show, if you're finding our content helpful, if you like tips in regards to retirement, or in regards to Social Security, or in regards to how to help reduce your retirement taxes, don't forget to sign up for our insiders list so you can get our weekly email on topics just like those. You can go to lifemoneyshow.com. It's right on the homepage there. Again, lifemoneyshow.com, right on the homepage. Scroll down a little bit. You'll find a spot where you can sign up for our insiders list. Well, you'll be on our weekly email as well. Hey, thanks for listening. I look forward to our next conversation, to helping you enjoy life today and be financially confident about your retirement.
Insurance products are offered through the Insurance Business Sirens Financial Management, Inc., Searns Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Searns Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Searns Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Searns Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Searns Financial Group, Inc.